right? So Nifty, when I shoot this video, is at around 9154. Let's put a full screen on this so that it looks nice. Oh, okay, so let's just add our simplest strategy, which is buy call. So 30th April is the expiry, the next expiry which is coming. So I'm going to add 9150 option. It has a premium of 153. You can see other options also here. So I'm going to choose the strike 9150, which is the closest to the current Nifty level. This thing is also called add the money. Don't worry about the name. So I'm going to add it, and let's see if I see this diagram. Okay, so we are seeing this diagram. So you can see that when Nifty goes up, I start making money, correct? So let's say that Nifty hits 9150. I make nothing. This is that bend in the graph. And as and when Nifty starts going up, I make 1 rupee. So Nifty's lot size is 75. So for every rupee move, I make 75. You can see it is incrementing by 75. So let's make this interesting and reset to 0. So at 9303, this is at 0 roughly. Minus 4. So let me see what happens when it goes up 1 point. 75 rupees it jumped up, 75 rupees, 75 rupees, 75 rupees. So yeah, right? Simple stuff. So one of the first things which everybody teaches you when they talk about options is profit and loss. So as you can see, there's no limit on how much money you can earn on this particular option. I mean, this can go on forever. So if Nifty goes to 13,000 tomorrow, so when I'm shooting this video, unfortunately this whole virus thing is going on. So if tomorrow, let's say magically we find a cure to it and we find out that paracetamol could cure it, I don't know what could cure it. Let's just hope that the best things happen and something cures it. Suddenly Nifty might go to 13,000, 12,000, I don't know what, right? We can never predict these things. So if it goes to, let's say 13,000, you'll make 2.77 lakhs per lot. So max profit is kind of unlimited. There's no limit. So if Nifty goes to 2 lakh, that's nice, right? You make around, oh, I don't even know how many zeros. It looks like a crore. So max profit is unlimited. So let's just reset to the current level, which is 9154, right? Maximum loss on this is only the limited premium you pay. So let's look at that, right? So you can see that at a particular level, it never reduces below this 11,479 number. 11,479 number is constant. Even if Nifty goes to 7,000 tomorrow or 6,000 tomorrow, I hope not, it goes to 11,749. So what does that mean? You only lose 11,479. So the first question is, where does this 11,479 number come from? It's very simple. 153 is the price of one option. You multiply it with 75. So let's just quickly do that. 153.05 multiplied by 75, which is Nifty's lot size, is 11,479 roughly. So this is the premium. So you never lose more than 153 per option or 153 into 75 per lot. That is the max loss, right? And this is important. Now this is where we start pulling in our non-expiry conditions. So your maximum loss is 11,479, right? So let's see. Let's see that Nifty goes to 8,700. You can see that on expiry you lost only 11,479. But here's the thing. You don't always have to make the max loss your loss. If you pull out early, you can lose less. So let's say that Nifty expires at 9,000, right? You lose 11,479 on expiry day. But if it's not expiry day, you won't lose that much. You can see that if you get out on Monday, you lose only around half of that money, right? So this is extremely important. You don't have to look at options always from an expiry perspective. You can get in and out earlier. In fact, most people don't hold these options till expiry. So max loss is the maximum loss you will have is the premium you pay, and less if you get out early. One of the most important things which option traders think about is, how much money do I have to pay? How much movement do I need to recover my premium? Or that point is called break even, when you have neither a loss nor a profit, right? So let's look at that. 9154 is the current level. And where is our break even? It's around, so I'm going to make a guess. See, you have to recover the premium, right? So that's exactly 153 point. So we will recover this at around 153 points. So let's see, 153 is the premium. Let's see, adding around 150 points to it, that is 9303, and this is roughly your break even. So break even happens when you recover the premium completely. So you can see that at 9303 you recover pretty much all of this premium. How did we arrive at 9303? The strike is 9150. So for every rupee above strike you make 1 rupee. You have to recover 153 rupees you have paid in premium. So 9150 plus 153 equal to 9303. Very simple, right? So this is your recovery and this is your break even. Now here's the other consideration about break even. How about if you get out before expiry? So let's just look at, so today is what, 24th April I think, and let's just say 30th April is the expiry. 27th April, your break even is not so high. In fact, you can break even somewhere around 9230, right? If you're pulling out earlier on 26th April, your break even is around 9200 odd levels. Basically break even, if you're buying an option, is lower, or it's easier to achieve break even if you get out of the option early enough. On the last day of expiry, your break even is so much more higher. So let's see this, right? If you get out today at 9200, you actually make a profit and get out, which means that your break even is somewhere around 9175, 9177. Yeah, you can see the break even, right? 9178 is your break even for today, but 9178 will not be your break even on expiry. You will still lose money. So this is about break even. So to recover the premium, so to break even, you have to recover the premium on expiry, and if it's before expiry, the break even is even lower. If the option price goes up a little bit, you can obviously sell and cash out. How it will go up, we'll see in the subsequent webinars, or even in this module we'll see that. So let's go on to the next slide. 3 very important points for option traders. Risk reward ratio. Trust me, risk reward ratio is everything in option trading. If you're an option trader, the only thing you have to be considering. In fact, if you're a trader, the only thing you have to be considering is risk reward ratio. POP is what is called probability of profit. We'll explain that. The third thing is capital needed, and the fourth thing is ROI. So risk reward is very high, right? Because what are you risking? Only that 11,000 rupee premium. How much is your reward? It's insane. It can be 30,000, 40,000, God knows how much it can be, right? If Nifty hits an upper circuit, you can make 1,000 into 75,000 rupees also, right? So it's very high risk reward. By risk reward, I mean reward to risk ratio. So that should be reward by risk, not risk by reward. And probability of profit, it's very low. So why am I saying that? Because see, if you have to make money on this option, right, to profit on this option, you need like a 150 point move. 9303 is 150 points away, and there are just 4 days left for that move. So 150 points in 4 days is a little difficult. I mean, I'm not saying that it's too tough, but relatively in terms of options, it's a slightly difficult move, because you have to recover the entire premium, and that you have to do within 4 days. Might happen, might not happen. Compared to other strategies which we'll look at later in this series, it is relatively low. And once we explain our second strategy, you'll understand why it's low. Capital needed. Capital needed is low because obviously it is just the premium you have to say buy to. So if you pay the premium, you can buy the option and you can do this trade. And 11,000 rupees, that's all you need to do this trade. It's low capital strategy. And because capital needed is very low, and because the profit in case you hit it is very high, the return on investment or ROI on this option strategy is very high. So it's like a perfect gambling instrument. You only have to pay a little bit of money and you get a lot of money and you get a lot of return on interest. And it's like very tempting to look at it like lotteries. And trust me, a lot of retail investors do this as lotteries, right? So let's look at the next thing which we are considering.